In this really quick video, we're going to finish up chapter 3, but I don't want you to, I don't want in any way suggest that because I can cover this concept in a few minutes, that this is in any way not important or not complex, because it is in fact both. And what we're going to talk about is the trial balance. Hopefully you remember from the discussions on double entry accounting the importance of being in balance. Debits on the left, credits on the right. And the total of all of your debits and all of your credits must equal. If that doesn't happen, you are not in balance. And while it is important to make sure at the end of each transaction that you are in balance, it is vitally important that you make sure that you are in balance prior to the preparation of your financial statements. So to ensure that you are in fact in balance before you prepare your financial statements, you're going to prepare what's called a trial balance. Now, what this trial balance will do is ensure that all of your that your transactions are in balance, and at least from that standpoint you can go forward and reliably prepare your financial statements. The trial balance is done in a particular order. It starts with assets, then liabilities, then owner's equity, then revenues, then expenses. There will be a column for debits and a column for credits. So you will go back, you will look at all of your asset accounts, which should have a debit balance at the end. You'll take your debit balance and you will put it in the debit column. You get to liabilities, which should have a credit balance or no balance at all if you have no liabilities. And so you would take that, assuming that you have a liability or multiple liabilities, and put those in the credit column, and so on. So here's an example of a trial balance for Mitchell's Campus Delivery. You will see that in fact we have all of our assets listed first, and that they in fact have debit balances. Nothing in the credit column. We'll then move on to liabilities. In this case, we only have one liability, and that's okay. It's got a credit balance, so it goes next into the credit column. We then move on to owner's capital, and our owner had an ending balance in his capital account of a $5,000 credit. We'll then move on to owner's draw, which had a $3,000 debit balance. Then move into revenue, a credit balance, and then all of our expenses come at the end, and those have debit balances. And lo and behold, we get to the end of our trial balance, and we tally up these two columns, and the debits and the credits equal, which is exactly what we want. If that isn't the case at this moment, this is the time at which you go back to your transactions and figure out where you messed up, because there is no point in moving into financial statement preparation if you are out of balance at this point. But since we are in balance, we will move directly into our financial statement preparation. Now, the first statement we're going to prepare is our income statement. That has our revenue and all of our expenses. We begin with listing our revenue, and then we itemize our expenses, and we then will tally the expenses up and put those right under the revenue column. We subtract our expenses from our revenue, and that gets us our net income. Now, the reason that we need to prepare this income statement first is that we need this net income figure to then prepare our statement of owner's equity. So we will plug the net income right off our income statement right into our statement of owner's equity. In this case, Mitchell began the business this month, and so as of June 1, he had nothing in his equity account. He started the business during June and invested his $5,000. So his total investment it was $5,000. He then, as a result of the operations of the business, has the benefit of increasing his equity as a result of net income. Now, had he had a loss from this period, that would have decreased his equity position. So that would have, a loss would have been entered here as a negative number. It's positive because it's income. And then we would subtract any losses, or excuse me, withdrawals, I apologize, withdrawals, and we're going to net together the net income and the withdrawals to come up with the total change in his equity position during the period. Because he withdrew less than the net income, his overall equity will go up by $2,250. We're going to add that to what the investments that he had, and his ending equity position is going to be $7,250. Next, we'll move to the balance sheet. Now, owner's equity, as you hopefully remember, is a portion of the balance sheet, and we can take this right off our statement of owner's equity and plug it right into the owner's equity section on our balance sheet. We go back to our trial balance, we take all of our asset accounts, we list those here, we add our liability account, and remember that our assets must equal the total of the liabilities plus the owner's equity in order for our balance sheet to balance. In this case it does, and we have now successfully prepared our financial statements that we know are in balance for the first period of operations. And that concludes this video.